Have you ever wondered how investors evaluate the financial health of a company? Well, there's a secret weapon that savvy investors use, and it's called the debt-to-equity ratio. It's a powerful tool that provides insights into a company's financial structure, revealing the balance between the money a company owes and the money it has from shareholders. It's a fundamental metric that helps investors assess the financial status of a company, understand its risk level, and make informed investment decisions. The debt-to-equity ratio is a compass, guiding investors through the complex world of finance and helping them navigate towards potentially successful investments. So, if you're intrigued by the world of finance or are an aspiring investor, you're in the right place. Stay tuned as we delve deeper into the concept of debt-to-equity ratio. This might just be the key to unlocking your successful investment journey. So what exactly is the debt-to-equity ratio? Well, it's a fundamental metric that provides insight into a company's financial health. Picture it as a balance scale, with the company's total debt on one side and its shareholders' equity on the other. This ratio is calculated by simply dividing the total debt by the shareholders' equity. Think of it as a way to measure how a company is financing its operations along with some indication of the level of financial risk it might be carrying. A higher ratio might indicate that the company is aggressively financing its growth with debt, which can be risky. On the other hand, a lower ratio may imply a more conservative approach with less reliance on borrowed money. This balance, or rather imbalance, between debt and equity gives us the debt-to-equity ratio. Now that we know the formula, let's look at an example of how to calculate it. Consider a hypothetical company, Company ABC. This company has been doing fairly well, but as potential investors, we want to dig deeper into their financial health. To do so, we're going to calculate their debt-to-equity ratio. So let's dive into the numbers. Company ABC has total debts of $500,000. This could be a combination of short-term and long-term obligations like bank loans, bonds, or accounts payable. On the other hand, the total shareholders' equity of Company ABC stands at $1 million. This represents the net assets of the company. That is, the assets remaining after all debts and other liabilities have been paid. Now, to calculate the debt-to-equity ratio, we'll use the formula we discussed earlier, total debt divided by shareholders' equity. Plugging in the numbers, we divide the total debts of $500,000 by the shareholders' equity of $1 million. The result is 0.5. What does this number mean? The debt-to-equity ratio of 0.5 tells us that for every dollar of equity, Company ABC has 50 cents in debt. In other words, the company has twice as much equity as it does debt. This is a relatively low ratio, suggesting that Company ABC is not overly reliant on borrowed money to finance its operations. It indicates a balanced financial structure where the company is funding its growth with a healthy mix of debt and equity. However, it's important to remember that a good or bad debt-to-equity ratio can vary greatly by industry. Some industries, like the financial sector, naturally carry more debt, while others, like technology startups, might have less. In the end, the debt-to-equity ratio is just one tool in your financial toolbox. It's a snapshot of a company's financial leverage at a given point in time, and a useful starting point in analyzing the company's financial risk. And there we have it. The ratio of 0.5 tells us that for every dollar in equity, the company owes 50 cents in debt. A ratio of 0.5, but what does this mean? This is where we delve into the implications of different debt-to-equity ratios and what they indicate about a company's financial health. Imagine a scale, with the company's total debt on one side and its equity on the other. This ratio is that scale, representing the relationship between the company's borrowed funds and the funds provided by the shareholders. A ratio of 0.5, like our example with Company ABC, suggests a balanced financial structure. For every dollar of equity, there's 50 cents of debt. This might indicate that the company is using its own funds effectively, alongside a manageable level of debt. Now, let's consider a higher ratio. Imagine a ratio of 2. This would mean that for every dollar of equity, there's $2 of debt. This could suggest the company relies heavily on borrowed money to finance its operations. While this isn't necessarily a bad thing, it could indicate a higher level of risk. On the flip side, a lower ratio, say 0.2, would indicate that for every dollar of equity there's only 20 cents in debt. This might suggest that the company is very conservative in taking on debt, which could mean less risk, but it might also mean the company isn't leveraging debt to potentially grow faster. But remember, these ratios don't exist in a vacuum. they must be considered in relation to the industry norms, the company's size, and its growth stage. A tech startup might have a higher ratio as it borrows to fuel growth, while a well-established utility company might have a lower ratio, reflecting its steady and predictable cash flows. In essence, a ratio isn't a definitive indicator of financial health, but rather a piece of the puzzle. It's a snapshot of a company's financial structure at a given point in time. So in understanding the numbers, remember, a high ratio signals risk, while a lower ratio may suggest stability. It's up to you, the discerning observer, to decide what these numbers mean in the grand scheme of things. How does this ratio affect investment decisions? This is a question that's often on the minds of those delving into the world of finance. The debt-to-equity ratio is a powerful tool, a sort of financial litmus test, that can guide investors as they navigate the often turbulent waters of investment decision-making. This ratio doesn't just exist in a vacuum, it's a critical part of the broader financial picture, providing valuable insights that can help shape an investment strategy. For investors, this ratio serves as a signal, a beacon in the financial fog. A high debt-to-equity ratio can be a red flag, indicating a company that's heavily leveraged, relying heavily on debt to finance its operations. This can signal potential risk, as the company may struggle to meet its debt obligations, especially in times of financial stress. But it's not all doom and gloom. On the flip side, a lower ratio can be seen as a sign of stability, suggesting a company that's financed more by its shareholders than by debt. This can translate into less risk for investors, as the company is less likely to face financial hardship due to excessive debt. However, it's critical to remember that like any financial metric, the debt-to-equity ratio is not a one-size-fits-all measure. It's a balancing act, a trade-off between risk and return. What might be considered a high or low ratio can vary significantly depending on the industry and the specific circumstances of the company in question. This is where industry benchmarks come into play, providing a yardstick against which a company's ratio can be measured. But as we delve into these numbers, it's vital to remember that investments involve real people and real companies. Each has its unique story, its mission, its vision, its leadership. It's about more than just cold, hard numbers. It's about the people behind those numbers, the individuals driving the company forward. So, as you navigate the financial landscape, remember this: investments involve real people and companies, not just numbers. Consider the debt-to-equity ratio as one piece of the puzzle, a guide to help you make informed, strategic investment decisions. Beyond the numbers, remember that investments involve real people and companies. The debt-to-equity ratio is a critical tool, but it's only a part of the story. When you invest, you're not just buying a piece of debt or equity, you're becoming a part of a company, its mission, and its future. Consider the company's leadership. Are they capable, experienced, and trustworthy? Do they have a clear vision for growth? A company with strong leaders may be a safer bet, even if their debt-to-equity ratio is less than ideal. And what about the company's mission? Does it align with your values? Companies with a strong sense of purpose often have a more engaged workforce, which can lead to higher productivity and ultimately, better returns. Finally, consider the company's growth potential. A high debt-to-equity ratio might be acceptable if the company has a clear path to rapid growth. The debt-to-equity ratio is a compass for investors, guiding them through the financial landscape. In conclusion, the debt-to-equity ratio is a key tool for investors. It acts as a reliable compass, providing an insight into a company's financial structure and helps in deciphering the company's approach towards debt and equity. As we've seen, a high ratio could signal a higher risk, but potentially higher returns, while a lower ratio may imply stability, but possibly lower returns. It's a delicate balance, and understanding this balance is crucial for making informed investment decisions. But remember, the numbers are just one part of the equation. The company's mission, its leadership, and its growth potential are equally important factors to consider. The debt-to-equity ratio may guide you, but it is your understanding and interpretation of the full picture that will ultimately lead you to success. Thank you for joining us. Make informed investment decisions and stay tuned for more financial insights.